Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. Thank you for taking time out of your holiday week to watch this weekly stock market update for the week ending Friday, December 21st, 2018. And man, do I have a lot of things to talk to you about today. This stock market is dropping faster than I've seen in a long time. Could be 7 or 8 years, or maybe all the way back to 2008. But the Dow Jones Industrial Average has dropped over 10% since the 1st of December, and there are a lot of indexes that haven't been as kind to investors. But before I get into the charts, I'd like to say that this is my holiday sweater. I told viewers last Christmas that I'd pick one out, and I picked out a Dales of Norway sweater because I've always liked these. And in the spirit of Christmas, I'd like to read a passage from Bill Bennett's book, The True St. Nicholas, and it's just a brief little quote here. "There is nothing wrong with exchanging gifts at Christmas. After all, the Bible tells us that the Magi brought gifts to the baby Jesus. It is when we lose a sense of moderation, when Santa's bag overflows with too many goodies, that the gift giving and receiving becomes a problem. As the ancient philosophers remind us, there is a proper measure in all things. Also, the history of St. Nicholas and Santa Claus is a kind of miracle in itself. It is a legacy that resonates with God's love." Those are some wise words from Bill Bennett. Well, with that, I'd like to wish you a very Merry Christmas, because the next video will be hopefully just before New Year's. And I cannot wait to see what happens in this market between now and then. The markets are extremely bearish, and I don't believe it's over yet. We have ways to go. I think we've got about another 10% probably to the downside for the Dow Jones, and about 6% more to fall for the S&P 500. There are some bright rays of sunshine out there, and all of that I will show you in the charts right now. Let's take a look at the charts, beginning with the Dow Jones Industrial Average. Looking at this chart of the Dow Jones Industrial Average over about the last 14 months, you can see that the Dow Jones peaked here on October 3rd, and since then it has been quite a ride to the downside. In fact, since October 3rd, the Dow Jones Industrial Average has declined by 14.9%, or we'll just call it 15%. So we're getting close to that big bear market level, which is what the TV likes to call 20% or more. So the Dow Jones is definitely approaching a 20% drop, and we don't have too far more to go. I think we are going to get to that 20% mark, because there is quite a far way to travel between where we are now and where I think we're going to find support for the Dow Jones Industrial Average. Before I do that, I'll just quickly fly through these indicators. The short-term moving averages, the red one is the 5-day moving average, and it's way below the 20-day moving average, indicating a lot of weakness over the last several days to a couple weeks. And in the intermediate term, meaning weeks to the last 2 or 3 months, the 20-day moving average in blue is below the purple 50-day moving average, which also is a sign of extreme weakness in the last several weeks and months. And for the first time in a long time, I'm going to go out and do the long term, because we haven't had a long-term signal, bearish weakness signal, since, I don't know, a couple years or so. And you can see that the purple 50-day moving average crossed below the 200-day moving average, which is not good at all for the Dow Jones Industrial Average. That only happens once every few years, and here we are. It just triggered that on the 19th of December. So a lot of caution needs to be had in this stock market. And let me show you real quick what has been broken and where we may be headed. I'm going to zoom out and draw a line from February of 2016, right here, the low of February 11th, and draw that up And you can see on this chart that we touched it February 11th, made the first point, touched it a second time November 3rd, just before Trump's presidential election, and then we touched it again here October 2018, and then we officially broke it back here in December, just this month. We tested it a few times, but we broke it back on about December 6th and then never looked back. It's been straight down for the Dow ever since. So where do we go from here? Well, if I zoom out all the way to 2009 and the very, very depths of the financial crisis of March 2009, right over here in the bottom left corner, you draw a trend line from there and connect it to the low right here of February of 2016. That, I think, is where the Dow Jones Industrial Average is headed. So we're already down about 15% since October 3rd. And if we go all the way down and test this 9-year trend line, then let's see how much of a percentage that would be. That would be about another 15 to 16% drop for the Dow to get down to the bottom red line here. So at that point, that would be about a 30% decline for the Dow Jones Industrial Average from the October 3rd high. And I'll tell you right now that that is going to make buy and hold investors question their buy and hold investment philosophy. That's not going to resonate too well with investors in the United States and worldwide. So that's where I think we're going. Use caution and pay attention to the Dow Jones Industrial Average over the next few weeks. And let's take a look at the S&P 500. Here's the chart of the S&P 500 stock index, and it has fallen very steeply as well since this last peak on December 3rd. And the S&P 500 peaked here on September 20th, that was the closing high. And since September 20th, let's see how far the S&P 500 has dropped. It has dropped in the last 3 months by 15.9%. So that also is a very stunning development for the S&P and worth paying extreme attention to as we go forward. Because just like the Dow Jones, the 2.5-year trend line has been broken, and let's see where we may be headed. I'm going to zoom out to the lows of 2016 over here. And this is the trend line that was broken recently from February 11th, 2016. Draw that on up to here. And we had the second point, November of 2016. And then I'll go ahead and adjust. Well, let's switch that over to a candlestick chart because that makes more sense. There we go. And let's connect those points just like that. And you can see that we held that trend line for 2.5 years, and we broke it in October, rallied up, collapsed, rallied up again, collapsed, rallied up again, and peaking on December 3rd, and then it was game over. So with this trend line broken, let me show you where we may be going next, and it requires going to the lows of 2009, just like the Dow Jones chart. Let me switch this chart back over to a line chart and draw it from March 5th, 2009 on up to here, and that is probably where the Dow Jones is headed. Oh, not the Dow Jones, the S&P 500. If that happens, how far does the S&P have to go to get there? Let's take a look. It would probably be about right there. To fill that gap, be about another 8% drop for the S&P 500. So we have quite a ways to go if that in fact is the case. I'm thinking that it probably is. So investors, protect your money, protect your IRAs, 401ks, mutual funds, that kind of thing, because this is the environment where buy and hold investing does not work very well. It's best to play defense. And let's take a look at some sectors that are actually doing well. and many that are actually very worrisome. I'll start off with the worrisome ones, and then I've only got a couple that are rallying to the upside in this environment. The first industry sector chart that I'll begin with is the Information Technology Stock Index, because this is full of stocks that people have been in love with for many, many, many years. Won't get into which stocks those were, but let's just say that they're the most prominent technology stocks on the planet. And let's see, this particular index peaked on October 3rd, and since October 3rd, the technology stock index has dropped by 19.7%. So just shy of the 20% mark. That is absolutely stunning. So technology is a breath away from the official mainstream media described bear market status symbol, I guess you'd say. So be careful with technology stocks. The second industry sector chart is the S&P Home Builders Stock Index. And since this is kind of a very important economic sector for the United States, let's see how the home builders have done since they peaked on January 22nd this year. The home builders are currently down, as of the recording of this video, by 31%. That is pretty stunning. I'm sorry, but that is not a sign of a rip-roaring economy and a incredibly strong housing market. Those poor home builders are feeling quite a pinch, very much like they did in 2008 and 2009. And 2019 will be a very interesting year for them, especially if you see how close we are on December 19th from taking out the lows of October 29th. So if we take out those lows, then I feel sorry for the home builders. Here's the Dow Jones U.S. Select Regional Banks Stock Index. These are smaller banks that are, as it says, regional instead of national. And they can sometimes be a little more temperamental in times of economic weakness, I guess you could say. And just wanted to point out how the regional banks are doing. The national bank chart doesn't look much different, but this one is the weaker of the two. And let's just take a look at how the regional banks have been doing since their high on March 9th. Regional banks are currently down 28% since March. So that's a very troubling sign for the banking sector. The other industry sector chart that's worth mentioning because of what it's going through is the Dow Jones Transportation Stock Index, which includes your airlines, railroads, delivery services, marine shipping, that kind of thing. And you can see that it is headed straight down quite rapidly. And since it hit its high right here on September 14th, the Dow Jones Transportation stocks are down by 22%. So another industry sector that is having a tough time. And I have a couple that are actually in the upward trend in this environment, and I'll point those out right now. This is a chart of the 30-year, we'll call it the Thomson Reuters U.S. 30-year government bond benchmark or index. And you can see that since November 2nd, 30-year U.S. government bonds have been rallying to the upside as people are looking for something other than stocks, probably. So there appears to be a rotation out of stocks and into U.S. government bonds. And the 30-year bond benchmark here, since that first day of, or I should say November 2nd, this particular index has risen by 9%, 9.01%. So a 9% rally in the 30-year government bond, corresponding to about a 10 to 15% drop in the U.S. stock market. So definitely opposing directions between bonds and stocks at this time. And here's the final chart of the day, the Gold Bugs stock index, also known as the HUI. These are gold mining stocks, and they have been in a downtrend all year until we got down to right here on September 10th, and we bounced and then pulled back and then took off again. But in addition to that Treasury or U.S. government bond chart I just showed you, the gold mining industry stock index, which is this one, has gone from September 10th to December 20th and risen by about 21% since September. So over the last 3 months, gold miners are up 28%, and that also compares to the uptrend of about, about 9% over the last few weeks for the 30-year U.S. government bonds. So gold miners are looking good on these charts as well as bonds. Thank you for watching this market update. Before you go, please do me a favor and click the subscribe button on this YouTube channel, and then click the little bell next to it so you'll be notified of additional videos when I post them. And in the summary description of the video and on the homepage of christensenwealth.com, you will find links to the Facebook, LinkedIn, and Twitter pages. And when you have time, please visit those when you can and like or follow them while you are there. That way, throughout the week, I can communicate with you on social media and through these videos. Well, have a great day, a very Merry Christmas holiday. Enjoy the holiday week ahead. Please, as I always say, stay vigilant, pay attention to your hard-earned retirement savings, because it's a lot easier to protect it than to get it back in times like this. And of course, as I like to say, getting back to even is not an investment strategy. So I would just say now's a good time to keep some hay in the barn until the storm passes. Well, with that, I will say I'll probably be back with another video in about another 7 days. So I'll see you then. Again, Merry Christmas. Bye-bye.